Hey guys, on today's episode, I am going to talk about 5 stocks I bought this week. It has been a crazy week, right? We hit the peak on Wednesday, I believe, and then the overall market dropped about 4%, but we've seen some stocks drop down 10%, 15% in the past 2 days. And today's episode, what I want to do is, like many of my viewers, I put money on the market on a timely basis. So for me, I put money every single week. I think for everybody has different lifestyle or different circumstances in life that maybe they don't do it every week. Maybe they might do it more frequently or less frequent. But the overall, at the end of the day, when you put money in the market, I personally come to this problem all the time. What stocks should I buy? And it's not that I don't have a list. I have a strong list of companies. I have, for example, my portfolio are all filled with companies that have done extensive research of multiple hours, some even multiple days before entering my portfolio. So it's not like I'm at loss with no positions to enter. I just honestly can't choose what positions because there's so many that I feel can continue to grow. So I feel like maybe some of my viewers might be feeling like that as well. So what I'm gonna start doing is every week I purchase a stock, I'm gonna just put what I purchased. Again, none of this is advice, but it might help others give some form of an open eye. Hey, I forgot about that company. Maybe it's a company I should take a little more look at. So today's episode is going to be broken down into the following. First, I'm just going to we're going to talk about the 5 stocks. For each of them, I'm just going to do a quick overview of the markets they hit. We're going to take a look at their future growth, at their past growth, and a quick look at their balance sheet for each of them. For each of them, I don't think we'll spend more than 4 to 5 minutes. So I hope you guys enjoyed the episode. And if you are new to my channel, if you are a long-term investor, and if you want to learn more about growth stocks, make sure to hit that subscribe button. To all my returning viewers, thank you so much for the support. It truly, truly means a lot. I honestly appreciate it. Remember, like always, if you guys want to get in contact with me, you can go in the YouTube comments. You can find me on Twitter. You can find me on Twitch. You can find me on my Discord channel. You can find me on my website at josenaharo.com. But remember, all the information that I have here, it's free. None of it is advice because I am by no means a professional. So make sure to talk to a financial advisor before making any financial decisions. All right, so the first company that I want to talk about is C. And this one is, I'm pretty sure if you guys have been following me for some time, you guys might be getting a bit bored of this stock because I just keep talking about it. But it is one of my tier 1 stocks. And also at the end of each stock, I would say what tier of my stock portfolio are they. So I have 3 tiers of stocks. Tier 1s are my best stocks and tier 3 are my worst stocks. And I don't want to say worst stock because they're not bad stocks. It's just the overall stage that those companies are in. For all three tiers, the way they enter my portfolio, they have to go through some extensive research. I have to believe in their product. I have to make sure their balance sheets are strong enough. So they all go through the extensive research, and I do believe all of these 3 tiers will overall beat the market. So that's why I invest, right? I invest in companies that will beat the market's results. But honestly, each company is in different stages, and some of them might have some products that I enjoy a little bit better. So tier 1 are usually established companies to some point where I can see them being a leader in the future in the market they hit. They already grown into at least a decent size force, and like I mentioned, they will continue to grow. Tier 3 are very similar. They're going to have a very strong balance sheet. They're going to have strong revenue growth. The only thing is they're a bit smaller right now, and they haven't really made a strong strength into the market they hit. But if they do hit that market and become leaders, I see them being as huge potential winners. So and then the tier 2 is a mixture of both of them. It's one that I couldn't really put in tier 1 and one I couldn't put in tier 3. So that pretty much explains my tier videos. And a lot of people are going to be like, Jose, why don't you just invest in your tier 1 companies? I honestly enjoy learning about companies. I honestly enjoy having multiple positions. So for me, that's the reason. I just enjoy it. And investing, like I said, all these companies are companies that are stocks that I believe are going to beat the market. So I don't feel like I'm giving up any form of results or rewards or gains by doing this. This is just the investing style that works for me. And your investing style might be a bit different, and that's okay, right? I don't believe this is not a single style game. You don't play investing with one game style. Everybody can do investing in their own method, and as long as that style fits you, then you're gonna be, I feel like that's way better than trying to follow other people's style. So the first stock I bought today, I bought this week, was C. And C Limited, let's just take a look at price performance. It peaked on Tuesday, and since Tuesday, this company is down about 11%. And one thing I do hear so many people talking about, it's like, Jose, see, I told you this bear market, it was overly bubble. Volatility happens in the market. I am a long-term investor, so this volatility does not freak me out at all. It's not something I worry about because, like I said, my fundamentals of the business I purchased have not changed. But within this 10%, 11%, this is a perfect example of why I invest on a weekly basis. And some people will be like, Jose, why are you holding cash to wait for it to drop some more? You don't ever know. The worst thing I think one can do, the worst thing I can do, is try to time the market. Right, even though the stock price dropped down to 144, this is actually still, unless I stopped buying on August 18th, I would have made money regardless any other time frame. So it's not like it's made a huge difference by me not saving money. If I invested here, I'm still up. If I invested in July, I'm still up. If I invested in June, I'm still up. The only time I wouldn't be up right now is, unfortunately, if I invested in Wednesday, August 5th, that one day it jumped up a bit, and any day after August 18th. But I dollar cost average, so that doesn't really affect me. So for me, I don't try to time the market. Again, I'm very young, so for me, I definitely have this time on my side. Again, it depends on all, like, the circumstances for everybody is different. All right, so C, now that I've done my rant, let's just go into the business. So first one is C. C is right now sitting at $142 after hours, and we saw it dropped over almost 11%, definitely over 11% with the after hours. Let's try to understand what C does, and I just want to do a quick understanding of the company. So product C is Southeast Asia. They're like in Singapore and Taiwan, and to me the best way to explain them, they're probably like the Amazon of that region. The three main markets that they hit are, they have the e-commerce which is their Shopee, something very similar to Amazon. They have C Money, which is their digital fintech services, and this is something very similar to PayPal, where you have with PayPal, Venmo, where you have a e-wallet, you can do transactions. Then the third one is actually the main reason I am bullish in this company, and it's Garena. That's their digital entertainment. So here you have like their video games, and other types of applications they have within their platforms in Garena. But the biggest ones there is definitely the video game industry, and it is growing at some crazy rate right now. So now let's take a look at the future growth for C. So C at the moment is expected to grow its revenue on average for the next 3 years for about 40% annually for the next 3 years. So again, that doesn't mean that this year will grow 40, next year will grow 40, and the year after that will grow 40%. Maybe this year might grow 100%, and the next years might grow like 10 each. I don't know if that math is right, but just to say, it's on average for the next 3 years, it's expected to grow 40% annually, and that's some crazy growth, if I may say. And now let's take a look at their earnings. Their earnings growth are also expected to grow at crazy levels, but unfortunately, C is not profitable right now, and they are not expected to be profitable until when is this? Until mid of 2022. And to me, that's okay, right? It depends for every type of investor. For me, as long as the company is expected to be profitable within the next 3 years, it's a company I'm willing to look at. The only thing is, when I look at companies that are not profitable, I am a lot stricter on that balance sheet. I need to make sure they have plenty of cash to survive and have very low debt at the moment. So now let's take a look at their past growth. And in their past growth, we are gonna take a look at just how they have grown in the past year. So in 2019, C grew 163% year over year. In 2018, it grew 100% year over year. And we've seen the numbers has grown this quarter have been in these high double digits, pretty strong. So we can see that 2020 to 2019, I feel is going to be another 50+% growth annually, and that's to me impressive. Who does not like to see that kind of returns? Like I mentioned though, C right now, it is unprofitable. So for C to be unprofitable, I have to be very strict on that balance sheet. So I pulled up their recent 10K report, and here we can see the cash and cash equivalents for this company right now, ending of June 30th, which was their most recent earnings, ended at $3.4 billion. So they have a nice amount of cash. They also have some restricted cash, but I'm not going to count that. And they do have some short-term investments, but it's very low that, again, not willing to count. So right now, $3.4 billion of cash, of quick cash. Now let's take a look. What kind of debt do they have? They have no short-term borrowings right now. These are just regular operation expenses. The only one I really care about right now is any convertible notes and so they have convertible notes. Nope, they paid that off. So the only thing they have here is this convertible notes, and this is the only true long-term loan that they have. There's nothing else I see. And that's about $2.1 billion. So $2.1 billion, and they have about $3.4 billion in cash. This company has enough cash to be able to survive the upcoming years, even though it's not profitable. So I'm really happy to see that. Now the second company, and now let me explain. To me, C is a tier 1 stock. This is one of my top, it's one of my top convictions at the moment. So C is definitely a tier 1 stock for me, mainly because of that gaming industry. Next, we're going to take a look at MercadoLibre. This is also very similar to C, except it hits a different market, a different geographic region, and it also hits a bit different markets. There are some similarities that we're going to take a look at. But look, see, for example, in the past month, MercadoLibre has, from its peak, has dropped about 11%. So we can see it's definitely, there has been a nice pullback, but compare this to 6 months ago, you're still making more money than, you still have more money than compared to July. And that's the thing, right? It's in a long-term game, the volatility happens. As long as I do research on my companies before entering my portfolio, then I'm not going to be worried about stuff like this. Unfortunately, there are a lot of new people on my Discord channel, and a lot of people were freaking out when these 10% days happen. And to me, I was as calm as a whistle. Once you can, I don't even know if that's a saying. I think I just made that crap up. But one thing is, you have to learn how to control your emotions. If you can't control your emotions in this game, it means that you are, you either don't understand the risk, or you are too you believe you're in too heavy. And to me, I try to control my risk by doing that. I understand my risk. 2, I understand the companies I'm buying. And 3, I don't believe I'm in too heavy. I still have assets outside of the stock market if things go bad, right? And I'm hitting it for the long term of things. So MELI, MercadoLibre, is ticker MELY. And here, let's take a look at what they do. Let me zoom in because I know there's some of you guys that kind of want to read with me, even though there's not much to read. So MercadoLibre has 3 solutions. The first solution is what they call MercadoLibre Marketplace. And this is pretty much just like the Amazon, just like C, is the overall e-commerce business where you can put listings and you can do other types of solutions within your e-commerce company in there. The second type they do is Mercado Envios, and this is, they've actually developed their own shipping facility, so they don't worry, they don't have to use mailing system, which allows them to be more efficient with their packaging if we're traveling. And right now, I didn't mention, MercadoLibre is pretty much the largest marketplace in Latin America. Some of the biggest countries they hit right now are Brazil, Argentina, and Mexico. But they're also in other countries like Chile and Uruguay. And I'm pretty sure they are expanding elsewhere. But I know the 3 major ones they're in are Brazil, Argentina, and Mexico. So we talked about the marketplace. They also have that shipping service. The third one, and the shipping service, they have like drop shipping. They have like fulfilled by MELI, and they have other platforms. The third solution is a fintech solution, very similar to C, and like I mentioned, very similar to something like Square or PayPal, where you have things like point of sales. So here, you know, when you go to a small business and they usually have like those card readers. Sometimes that it depends on the companies. We have like Square, we have Four, MERCADOLIBRE in Latin America that uses these hardwares to do transactions. So this is it's a pretty cool platform. For me, e-commerce and the fintechs are markets I am very, very bullish on. Now let's take a look at their future growth. So MELI is expected to grow around 30% annually for the next 3 years, and they're expected to grow their earnings at 61.5% annually. So they're growing both their earnings and revenue at a super crazy rate. And just to put in perspective, right, anything growing over 15%, many investors consider that a high growth stock. So these are growing, this MELI is growing at 30%. We saw C growing at 40%, I think we mentioned. So we can see these are both two high growth stocks. MELI right now is expected to be profitable by the end of this year. They should have some profitable returns. So that's definitely some good things to see. Next, let's take a look at their past growth. So their past growth, in 2019, MELI grew 60% year over year. In 2018, it grew 18% year over year, so still a high growth, right? 18% is still pretty strong. And in 2017, they grew 44% year over year. Now let's take a look at that balance sheet. So balance sheet for MELI, I believe it's even a bit stronger than C. And I like this, right? Because MELI is already profitable as well, or is expected to be profitable within this year. So MELI right now has current debt of about 600 million and has non-current debt of about 800 million. So that's closer to $1.4 billion of debt. And look, they have current investments of 2.3 billion and cash equivalents of 1.7. So they pretty much have quick cash of about $4 billion. So this company MELI has enough cash right now to pay off its total debt. So to me, this is a very, very strong company. So for me, MELI is not a tier 1 stock for me, unfortunately. The reason C makes it in tier 1 and MELI doesn't is mainly because of that gaming aspect. I do believe the digital entertainment is just a whole different market that's gonna continue to grow. But MELI is definitely one of my tier 2 stocks. If maybe right now it might be a tier 3, but it's one that is working its way up to a tier 2 position size. The third company we're gonna take a look at is CERENCE, and this is ticker CRNC. And if we take a look from the peak, CERENCE right now is down 12%. So again, unfortunately, it sucks if you bought at these prices, but to me, I'm here for the long term of things. So I don't believe this peak for me is the top for it. CERENCE right now has a market cap of about 1.83 billion. And let me just give the market caps of the other companies. MELI has a market cap of 53 billion and C has one of 70. I want to say 70. Yeah, about 70 billion. I'm honestly surprised that I understand. I remember that. So CERENCE is a pretty interesting company, and they have pretty interesting products. They work, their biggest asset is the strength in into technology in voice world for automobiles. So a lot of the innovations and a lot of the innovations and products they deal with are dealt with the overall car world automation to pretty much make your car smarter and better with voice command. For example, they've actually have this, they deal with it with machine learning and artificial intelligence as well to make their product even stronger. One thing, for example, let's say you're reading a message, you have a message on your phone in your car, and your car reads the message. On a regular product, it just reads the message in a monotone robotic voice. With CERENCE, with machine learning and artificial intelligence, it actually changes its monotone of the way the message is read or whatever is being read to kind of do more of a human-like voice sounding, right? To make it seem less robotics. And they have other solutions, but and they have a lot of technology in 325 million cars right now. They have I believe the voice world is going to be one that is also going to be used. This technology can also be used outside of automobiles. But right now, even the automotive market is one that I see they're going to continue to grow in. So let's take a look at the market cap. I mentioned 1.8 billion. So this is pretty small market cap right now. Right now, they are expected to grow their revenues at 13.2% annually for the next 3 years. And one thing I want to say, due to COVID-19, there has been a decrease in new car purchases, so this might have slowed down this company's growth within the coming years. But I do believe the technology is still going to be needed in the future. So CERENCE is profitable, except this year. This year, due to COVID-19, they are expected to end up with a loss. But we can take a look at prior years and the upcoming years that CERENCE is definitely a profitable company, and that to me is pretty good. Next, let's take a look at their past growth. In 2019, they grew 10% year over year. In 2018, they grew 13% year over year. And in 2017, they grew 16% year over year. Now let's take a look at that balance sheet. They have about $300 million in non-current debt and about $100 million in current debt. So close to $400 million of debt. And they have about $132 million in cash. So right now, they don't have more cash than debt. And that to me, like I said, if it was a company that was not making money, this would be a problem. But we saw CERENCE, they are profitable and they have been profitable. So it's okay for them to have a little bit leverage of cash to debt because they have some form of income. Just like you and I, if I have a job, if I have a steady income, it's okay for me to have a leverage, some form of leverage, right? My mortgage is a leverage between my income and my mortgage, right? So, and that debt I own. But let's say if I wasn't making money, if I wasn't making money, I wouldn't want to have any debt because I didn't have a flow of cash coming in. So you got to understand what stage the business is in as well. So it's not the best balance sheet, but I'm 100% okay with it. So now let me talk about CERENCE. CERENCE is actually one of my tier 1 stocks as well. And again, I believe this is a market that's going to continue to grow as the years progress. And like I said, the technology that they have, I can see being implemented in other products outside of automobile. Just the overall voice assistant market and them continuing to innovate it with machine learning and artificial intelligence is just a whole different ballgame for me. Next, the fourth company is REDFIN, and REDFIN right now has a market cap of about $4.5 billion. And since their peak this month, they have dropped 11%. So we can see these companies have dropped a nice amount. So what does REDFIN do? REDFIN is a very simple company to understand. They're kind of trying to disrupt the overall real estate market. They try to bring the commissions down. They make it easier for you to purchase the products they have. They have their own agents. They have like their own services after purchasing a house, like the mortgages, titles of services, and all the other services that are used during the house purchasing. So now let's take a look at their growth. So REDFIN right now is expected to grow 23.1% annually for the next 3 years on average, and they're also expected to grow their earnings. And we can say, right, all the companies I'm buying are in different markets. We see C was in the gaming market, but it was also e-commerce. MELI was in the e-commerce as well, but now REDFIN is in the real estate market. And again, so we can see I hit different markets as well. Right now, unfortunately, REDFIN is not profitable, but they are expected to be profitable within the next 3 years. At the end of August 22, they should end up kind of profitable, almost breaking flat even. So we know what that means. We have to make sure that balance sheet is strong. But now let's take a look at their past revenue growth. In 2019, it grew 60% year over year. In 2018, it grew 31%. And in 2017, it grew 39%. So this is a crazy grower, and we're seeing it's still expected to grow. Now let's take a look at that balance sheet. Balance sheet for REDFIN at the moment. Let's take a look at that quarterly data. They right now have non-current debt of about $177 million. Out of that $177 million of non-current debt, they do have $360 million of cash and cash equivalents and $170 million of current investments. That's total of $530 million of quick cash. So they have plenty of cash to pay off that non-current debt. So again, that's great because this is a company right now that's not expected to be profitable anytime soon. So we got to make sure that balance sheet was strong. Now for my last company, and REDFIN for me is definitely a tier 3 company right now. I can see it eventually becoming a tier 2, as I might build up a position on it. It would never be a tier 1 stock, that's for sure. And it's not because any bearish reasons. I'm just a little more bullish in other markets, but I believe these are companies that will still beat the market. So the final company is going to be TWILIO, and this is ticker TWLO. And compared to its peak on Wednesday, this company is down 15%. And that's insane. This one definitely has taken a big hit. Right now, it has a market cap of about $35 billion. So again, it's not that big of a company. Smaller than C, smaller than MELI. A little bit, it's bigger than CERENCE, and I think it's bigger than REDFIN. So we can see, not only am I hitting different markets, I'm also hitting different valuation points and seeing where a company is at in different stages. And all these companies, I have done due diligence where I have done a lot more research than what I'm doing now. This is just a quick overview on them. So TWILIO, what do they do? It's very simple. They do integrations for companies to use their products in some form of messaging. For example, when, let's say when you're, I don't know if these companies use them, but the products that they do are pretty similar. When you're trying to log into your bank, and sometimes they might send you a verification number that you have to plug in so you can show that, yes, this is me. Well, that's what TWILIO does, that product where they integrate that for that customer. So let's say whatever customer uses them, they can send form of text to their customer regarding from multiple things like picking up our order, letting them know that the order is ready, letting them know that delivery has taken place, giving them the verification number. Another thing they do is they do like video integrations. Let's say I wanted to build an application that I was able to communicate video through video chat with my customers or my users of my applications. TWILIO already has some form of integration with it, so we can use their already developed product into my application, so I don't have to do that extra work, right? So that's pretty amazing. And then there's other markets that they hit. For some reason, I can't hit next. So they have like the messaging, like I told you. They have programmable voice. They have programmable video. They have APIs that can be used through emails, through WhatsApp. So we can see this is definitely in very strong markets. Netflix uses them right now to send your 2-factor authentication code. We have Blue Apron using them. We have Doctor on Demand using them. So this is a pretty cool product that I believe. And TWILIO is a tier 2 stock for me right now. But let's take a look at that growth for TWILIO. TWILIO right now is expected to grow 19.7% annually for the next 3 years. Their earnings are also expected to grow at a fast rate. But unfortunately, TWILIO is not expected to be profitable anytime soon. So it's a little scary, right? It is not profitable. So in theory, it should have been a tier 3 stock for me. It's not expected to be profitable anytime soon, at the end of 2023. But I do believe this form of market, this is a tool that other applications and with the form of content creation and applications creator just continue to increase, I do believe there is growth in this market as more people are developing more apps and needing cool integration platforms with messaging, with video, and with other stuff. TWILIO will probably be one of the first places to come and look at that. So that to me is pretty cool. It's a market that I believe is going to hit. Now let's take a look at past growth. But we did see, right, it's growing almost at 20%. It's still considered a high growth stock. In 2019, it grew 74% year over year. In 2018, it grew 62% year over year. So it has been growing at super speeds. And now let's take a look at that balance sheet quarterly. So TWILIO right now has non-current debt of $650 million and current debt of about $42 million. So total debt of $700 million. This company has cash of about $500 million and current investments of $1.4 billion. So close to $1.9 billion of quick cash. This company has enough cash to pay off its total debt. So that to me is definitely okay. They have a strong balance sheet. So TWILIO is definitely one with a strong balance sheet, and it has a really strong one for a company that is not going to be profitable anytime soon. And like I mentioned, TWILIO is one of my tier 2 stocks. But like I said, all of these are tier something in my portfolio, and for them to even enter into my portfolio, I had to do some form of due diligence. So that's it for today's episode. I hope you guys enjoyed it. Maybe I might have brought some new companies to you. Maybe I just would have shown you some companies that you totally forgot about. So let me know, is this a series you guys want to keep watching? Is this something that you guys like? If you do, it's something I will continue to do. So take care, guys. Have a good night and see you next time.